Welcome back. We now cut across to an exclusive chat my colleague Pallavi is having with Aditi Nayar, Chief Economist at ICRA, about the Q4 current account surplus. Let's hear her view.
We're back into a modest current account deficit from this quarter onwards. The data that we have for April and May is tracking higher merchandise trade deficits than the year ago level on the back of now higher commodity prices. Broadly, I would expect that we're going to run a very mild current account deficit of about 1 to 1.2% of GDP in FY25. And for the first 3 quarters, we're looking at absolute numbers of between about $11 and $14 billion each, and a much smaller current account deficit in Q4, which is traditionally the case.
Okay, all right. So talking a little bit more about the current account deficit that's expected for FY25 as well as across most of the quarters. So that's approximately about 1% to 1.5% of the GDP. Is that right?
So for the year as a whole, we're expecting a current account deficit of 1 to 1.2% of GDP. And this is broadly building in crude oil at an average price of $85 per barrel over the full course of the year.
Okay, I do want to understand what is going to be the likely impact of the funds from the bond inclusion on the balance of payments. Does that bode well for the balance of payments and also for the rupee? What is your outlook in the next few months?
So that will come in on the financing side and will certainly take care of a large part of the financing of this very modest current account deficit that we're expecting in FY25. For the rupee, possibly part of this year, there's going to be more of a tendency towards appreciation rather than a tendency towards depreciation as we saw over the last year. And overall, I would expect that the rupee is going to remain relatively stable in a narrow band in FY25 as well.
All right, well, that's Aditi Nayar telling us about what she makes of the surplus as well as the mild deficit that we can in fact expect when it comes to the current account. But moving on, let's